Welcome again, dear students and scholars. We are continuing ASC 326 and now we move from scope into measurement. In video 1, we learned where credit loss guidance applies. In this lesson, we activate the CECL measurement engine. We will learn what the allowance represents, which information layers build the estimate, how pooling works, which measurement methods are acceptable, and how the calculation finally becomes a journal entry. Let us quickly locate where we are in the series. Video 1 helped us route the asset to ASC 326 20. Now, video 2 measures the loss. The process is practical. First, identify scope, then estimate the expected credit loss, then record the allowance and expense, and then update the estimate at each reporting date. So, today we are not asking whether the asset belongs here. We are asking how much credit loss should be recorded. Here is our learning path. We start with the allowance concept because every calculation must connect back to the financial statements. Then we build the CECL input model, study pooling by similar risk characteristics, compare estimation methods such as DCF, loss rate, roll rate, probability of default, and aging schedules, and then apply everything through examples and practice. The goal is not just to memorize methods. The goal is to know which method makes sense and how the number is supported. The core allowance idea is simple but powerful. Start with the amortized cost basis of the financial asset. Then estimate the portion that is not expected to be collected. That uncollectible portion becomes the allowance for credit losses. The allowance reduces the net amount presented on the balance sheet and it must be updated at every reporting date. CECL does not ask only what has already failed, it asks what collection risk exists right now, including losses that have not yet become actual defaults. Recording the allowance affects two statements at the same time. On the income statement, the entity records credit loss expense, which reduces income in the period the estimate is recorded or adjusted. On the balance sheet, the allowance for credit losses reduces the amortized cost basis of the financial asset, presenting the net amount expected to be collected. In later periods, if conditions worsen, the allowance increases through more expense. If conditions improve, the allowance can decrease through a reversal. So, this estimate lives in both performance and position. ASC 326 20 does not force every entity into one formula. Instead, it tells us to consider four information layers. The first layer is historical loss information. The second is current conditions. The third is reasonable and supportable forecasts. The fourth is reversion to historical information when forecasts are no longer supportable. These four layers feed into the expected credit loss estimate. Think of it like building a professional accounting estimate, not throwing 1% into a spreadsheet and hoping the auditor is in a good mood. Historical loss information is the starting point, but it is not the final answer. The entity must use relevant historical credit loss experience that matches the assets being measured. If the current portfolio is different by type, term, industry, credit quality, or economic setting, then old history may need adjustment. Blindly using the most recent historical rate can be misleading. The exam trap is clear. The historical loss rate is not automatically the CECL allowance. It is the baseline before current condition and forecast adjustments. Pooling is a major judgment area. ASC 326 20 generally expects collective measurement when assets share similar risk characteristics. If the assets are similar, measure them together in a pool. If they are not similar, evaluate the asset individually or assign it to a better pool. And do not measure the same asset twice. Pooling is not just an administrative convenience, it must make credit risk sense. A neat spreadsheet with the wrong pool is still the wrong answer, just wearing a very tidy suit. Risk characteristics help decide whether assets belong in the same pool. Useful factors may include risk rating, asset type, term, credit score, collateral type, location, industry, and vintage. For example, short term trade receivables from stable customers should not automatically be pooled with long term loans to financially stressed borrowers. The pool must reflect genuine shared credit behavior. The key memory line is this: pool by risk, not by convenience. The second input layer is current conditions. Historical data came from the past, but the allowance is measured today. If customer payment behavior has slowed, that matters. If a borrower industry has weakened, that matters. If collateral values have declined, that matters. If macroeconomic conditions have improved or worsened, that also matters. ASC 326 requires the entity to adjust historical loss information so the estimate reflects today's asset specific and economic environment. The third input layer is the forecast layer. CECL requires reasonable and supportable forecast when that information can be supported. Forecasts may increase or decrease expected losses depending on whether conditions are expected to deteriorate or improve. The forecast period is not fixed by a universal rule. It depends on how far the entity can reasonably support the estimate. Internal information, external economic data, quantitative modeling, and qualitative judgment can all be relevant. But a forecast is not a guess with a spreadsheet costume. It needs evidence and documentation. The fourth input layer is reversion to history. No entity can forecast perfectly forever. When the reasonable and supportable forecast period ends, the estimate must revert to historical loss information using a documented method. That reversion may be immediate, straight line, or another systematic approach, depending on the facts and the entity's policy. The transition point and method must be supportable and consistently applied. Reversion prevents long range forecasting from becoming speculation dressed as precision. Now let us compare the estimation methods. ASC 326 allows flexibility but not carelessness. A discounted cash flow method measures expected cash flows at present value. A loss rate method applies an expected loss percentage to the amortized cost balance. A roll rate method tracks movement through delinquency stages. A probability of default method uses default probability, loss given default, and exposure at default. An aging schedule applies different rates to different past due buckets. The method should fit the asset, the data, and the entity's ability to apply it consistently. The DCF method is the most direct cash flow approach. The allowance equals the amortized cost basis minus the present value of expected cash flows. The discount rate is the effective interest rate of the financial asset, not a fresh market rate chosen at the reporting date. That is a critical technical point. The DCF method captures both amount and timing. If cash is expected later than originally scheduled, present value may decline even if the total dollars are eventually collected. Timing is part of credit loss measurement. Many entities use non DCF methods because they are practical for large portfolios. Under the loss rate method, the entity applies an expected lifetime loss rate to the amortized cost balance. Under the roll rate method, it studies how balances move through delinquency stages toward default. Under the probability of default method, it estimates PD, LGD, and EAD, which means probability of default, loss given default, and exposure at default. Under the aging schedule method, each past due bucket receives its own loss rate. Different tools can work, but each tool must produce a supportable expected loss estimate. The measurement period is the contractual term of the financial asset. CECL is not a 1 year loss model unless the asset's contractual life is 1 year. Expected prepayments are considered when relevant and supportable because prepayments can shorten the expected collection period. Extension and renewal options are included only when the contract requires the lender to extend or renew in a way that exposes the entity to credit risk. For lesser net investments in leases, use the lease term. The period matters because the wrong period means the wrong allowance. Accrued interest receivable has a practical policy election. Because accrued interest can be part of amortized cost basis, it could otherwise complicate the allowance calculation. ASC 326-20 allows an entity, by financing receivable class or major security type, to elect not to measure an allowance on accrued interest receivable if uncollectible accrued interest is written off timely. This is not a free pass to ignore losses. It is a simplification tied to timely write off, consistent application, and proper disclosure. Now we move to example 1. Apex Components has a 2026 portfolio with an amortized cost basis of $2 million. The historical loss rate is 1.6%. Current conditions add 0.25%, and forecast plus reversion adds 0.15%. Together, the expected credit loss rate is 2.00%. The task is to calculate the allowance using the loss rate method and record the journal entry. The calculation is $2 million multiplied by 2.00%, which equals $40,000. The entry is debit, credit, loss expense for $40,000 and credit allowance for credit losses for $40,000. The expense reduces pre-tax income. The allowance is a contra asset, so the asset is presented net at $1,960,000, calculated as $2 million less the $40,000 allowance. The journal entry balances and the financial statement effect is clear. Example 2 uses an aging schedule for Brightmart traders in 2027. Current receivables are $600,000 at 0.5%, giving $3,000 of expected loss. Receivables 1 to 30 days past due are $80,000 at 5%, giving $4,000. Receivables 31 to 60 days past due are $30,000 at 18%, giving $5,400. Receivables over 60 days past due are $10,000 at 45%, giving $4,500. Total expected loss is $16,900, so the entry is debit credit loss expense and credit allowance for credit losses for $16,900. Net receivables are $703,100. Here are common measurement traps. The first is using history without current condition or forecast adjustment. The second is pooling assets with different risk profiles just to simplify the work. The third is ignoring reasonable and supportable forecasts when they exist. The fourth is forecasting too far into the future without support instead of reverting to history. The fifth is using last period's allowance without reassessing it. CECL is a current estimate model. It is not a copy and paste model, even though copy and paste may be very tempting at month end. Now choose your answer. A company has $1,500,000 of amortized cost receivables. The historical loss rate is 1.20%. Current conditions add 0.30%, and reasonable and supportable forecasts add 0.20%. What allowance should be recorded? First, combine the expected loss rate. Then apply that rate to the amortized cost balance. Think through all three components before locking your answer. The correct answer is option C, $25,500. The total expected loss rate is 1.20% plus 0.30% plus 0.20%, which equals 1.70%. $1,500,000 multiplied by 1.70% equals $25,500. Option A uses only the historical rate. Option B includes history and current conditions but misses the forecast adjustment. Option D uses 2%, which is not supported by these facts. If this lesson helped you, please like the video, subscribe to the channel, support the course, and share it with colleagues learning US GAAP. In the next video, we will cover purchased credit deteriorated assets, off balance sheet credit exposures, and collateral in CECL measurement.